Good morning, everyone. I'm Joanne Westwood, Accountability Manager at Vancity, and I'd like to thank Sonia for providing me with the opportunity to present, and also Catherine for setting up this recording. Of course, I wish I could be there in person, but due to other priorities, this wasn't possible. Today I'm going to talk about integrated reporting at Vancity with three main themes. The first theme, which is the bulk of my presentation, is the history and progression of reporting at Vancity. This is an interesting story, and here I'll get into some of the details around our processes, the standards we use, and how our stakeholder engagement and communication practices are evolving. Next, I'll highlight some of the ways we report our community impact and our co-op identity. And to conclude, I'll give some examples of how reporting adds value. So first, a quick overview of Vancity. We're a cooperative, of course, and a full-service financial institution with 57 branches located throughout BC in Canada. We've around $17.5 billion in assets, 2,500 employees, and 500,000 members. We're guided by a vision to redefine wealth. We're a living wage employer, carbon neutral, and a member of the Global Alliance for Banking on Values. And for those of you who aren't familiar with the Alliance, it's a network of values-based financial institutions using finance to deliver sustainable development for underserved people, communities, and the environment. So on to reporting. Reporting is a journey, and for us it's already been quite a long journey and one that's far from over. We first began reporting social and environmental information in our annual reports in '92. This was before my time at Vancity, but I understand this was triggered by a survey that ranked us poorly in terms of disclosure. Our board felt that as a community-owned and operated credit union, we needed to be accountable to our members for our social, environmental, and economic performance and impact, as well as for our financial results. And so in '96, our board committed us to an externally verified social audit. And a couple of years later, exposure drafts of both the GRI Sustainability Reporting Guidelines and the A1000 framework came out. We were one of the first organizations in the world to release a sustainability report informed by both these guidelines. For a few years, we continued to produce standalone sustainability reports, which we called accountability reports. But because it was so onerous to produce, we only produced one every 2 years. We received international recognition for our reporting practices, and we became involved in working groups to influence the development of these standards. We first began to consider producing an integrated report as early as 2005. It just made sense to us as we were running our business in a way that incorporated sustainability factors into decision-making, albeit quite informally. So we commissioned some research on leading practices and implications for Vancity. We quickly realized that the first thing we needed to do was to streamline our sustainability data collection and verification processes. We decided to use an online data management system called Credit 360, and this houses data supporting documentation, explanations for changes in data over time, and so on. And other changes we made included making sure the various departments across Vancity took full ownership for their data, both in terms of data quality and managing performance. And in this way, we were able to meet a much condensed annual reporting timeline. But perhaps the biggest driver of integrated reporting for us was the launch of our bold vision to redefine wealth. And that was in 2008. And it challenges us to support our members and communities in new and innovative ways that create long-term blended value to members and society as a whole. This vision is reflected in our business strategy. And while many organizations have separate business and sustainability strategies, we just have one business strategy which incorporates sustainability factors. It is also reflected in our organizational targets and in our remuneration and governance practices. In this way, integrated reporting has been a natural progression. It allows us to tell one story to members in a connected, consistent, and credible way, and to explain how our key activities, rather than generating profits to benefit the community in a profitable way. We published our first integrated report in 2010, and since then we focused on aligning our financial and sustainability reporting and assurance cycles. We've focused on aligning internal and external reporting, and we've also begun to strengthen the linkages between reporting and our business strategy. This has led to some important changes to our management and reporting practices. For example, we consolidated 2 scorecards into one organizational scorecard. And these were the scorecards that management used internally to track performance against our strategic priorities. and the scorecard we published in our accountability reports, which included some additional non-traditional performance targets. So now we have one consolidated scorecard. Second, this year we aligned the structure of our annual reports to the framework used in our quarterly internal performance reports. And third, for the first time we made our future-looking 3-year plan, which is the outcome of our annual strategic planning process, available to members, community partners, and peers online. So rather than creating a list of future targets and one-year commitments in our report, we included a short summary, our organizational scorecard, and a link to the 3-year plan. In terms of the reporting standards, we try to keep an eye on all developments in reporting, whether financial, sustainability, or integrated. But there are 3 frameworks in particular which have informed our reporting practices. And these are the A1000 principles, the GRI Sustainability Reporting Guidelines, and the International Integrated Reporting Council's Integrated Reporting Framework. Quite a mouthful, that one. All these frameworks continue to evolve, and navigating the reporting landscape remains a challenge. The onus is on us, the organization, to figure out what approach makes the most sense. The standards are complementary, but each has a different purpose and audience. But they are all principles-based, which we think is important as it allows us the flexibility to tell our story in our own way. I'm not going to cover each standard in detail, but I'll try and explain briefly our thinking around each one. So first, the A1000 principles of inclusivity, materiality, and responsiveness. These principles are not only about reporting, rather they speak to how an organization runs its business. This is in fact true of all the reporting guidelines, and the misperception that they are just about disclosure is perhaps one of the biggest challenges reporters face. Specifically, the AA1000 principles speak to how organizations include, prioritize, and respond to legitimate stakeholder needs and expectations. This concept of stakeholder inclusivity is also found in the GRI and the integrated reporting frameworks. The AA1000 principles and the co-op model, which by its nature is inclusive, are very aligned. But the main reason we use the AA1000 principles is to provide a basis for an external audit opinion that goes beyond data reliability. We believe if you're going down the route of an external audit, or assurance as it's typically called, that it should provide report users with confidence in 2 areas. First, is the key data and information in the report right or reliable? This key data and information in an integrated report particularly is presumably the same data and information that management is using to make decisions. So it is important it is correct, both to management and also to those people who form opinions and make decisions based on what they read in the report. But we also believe assurance should answer the question, is the right information in the report? This is harder to assure, but it speaks to if the report covers things that are most relevant and important, including the bad and the ugly, along with the good. On to the GRI guidelines. The guidelines add credibility to our reports as we're using a standard to guide what and how we report versus cherry-picking those performance aspects that make us look good. Ideally, they should also help us benchmark our performance against other organizations within the banking industry who are also using the guidelines, but we've not had much luck there yet. The most recent version of the guidelines, G4, requires that organizations focus their reporting and therefore management efforts on the material aspects of its sustainability performance. This is a good thing, and it should lead to more relevant focus and shorter reports. For those of you who maybe aren't familiar with the concept of materiality, it's about ensuring you understand the sustainability risks and opportunities that are of most interest to your key stakeholders and or are of most importance to your organization's success in the short, medium, and long term. However, determining what is truly material remains an ongoing challenge for us and just about every other organization I've talked to. In our latest report, we included a list of 25 material topics. We think it should be fewer, but we're just not confident about dropping any without understanding more. So this year we're planning to conduct a revised process in partnership with our risk division to try and do a better job at prioritizing topics. To be honest, I have no idea how this will go, but I'm excited to try. I also think the partnership with risk will legitimize and therefore elevate the outcome of the materiality process. The outcome of processes run by reporting teams, such as myself, tend to be viewed quite narrowly around disclosure, rather than as an input into strategy and risk and so on. And finally, there is the International Integrated Reporting Framework. A final version was released in December. Vancity was the first Canadian organization to join the Integrated Reporting Pilot Program. We are one of 3 now, all Vancouver-based firms. A question we're often asked is, what has been the influence of being a part of the pilot program and applying the framework on our reporting practices? We began producing integrated reports prior to there being a framework, and I've already touched on many of the changes integrated reporting brought about in general. But in addition to these, through our application of the integrated reporting framework, we've improved specific areas of our reports. For example, we've strengthened our discussion of external trends and developments that could materially impact the organization, including stakeholder insights. We strengthened how we communicated the links between strategy, governance, risk, remuneration, and KPIs. And we continue to produce shorter, more focused reports by elevating the conversation to a more strategic level. As well as these changes, the conversations with other organizations and the integrated reporting folks themselves have been really helpful. But probably the biggest benefit cited by organizations in the pilot program has been the breakdown of silos and more collaboration between the various areas of the business, especially between finance, sustainability, communications, risk, and strategy. A key area where we haven't applied the framework is the 6 capitals. These 6 capitals are financial and manufactured, which are more traditional and measurable ones, and then intellectual, natural, human, and social or relationship capital. The framework suggests organizations look at each of the 6 capitals in terms of both the inputs and outputs of the business model. As we don't use this framework or the language of the capitals internally, we don't include this in our annual reports. I suspect we might at some point adopt this framework as our finance team is exploring an integrated balance sheet, and the capitals might prove a good lens for which to look at this. When it comes to stakeholder engagement, we're implementing a more coordinated approach to engaging with members, communities, and other key stakeholders, and to prioritizing and responding to the insights raised through the engagements. We've begun reporting a summary of member and community insights to executive every month. This has been driven by the reporting guidelines, which require us to be clear around stakeholder priorities, but also by our strategy and our business model, which we call member-led innovation, which is pictured on the slide. And yes, those squiggly red lines are mine. But while we recognize the benefits of a more formal and coordinated process, we don't want one that's too structured or restrictive. And while we want our organization to be led by our members, in some circumstances we recognize that we might need to lead our members and bring them along with us. So what does this look like, and what is the right balance? These are some of the questions we're grappling with. On to the fun part, communications. We know from focus groups that we hold every year that our integrated annual reports are highly valued by employees and members. They find them educational, comprehensive, easy to read, believable, and effective in validating the reasons why they choose to bank or work at Vancity. After reading the report, members state they feel compelled to recommend Vancity to others. The only problem is the majority of our members don't read our reports. Our biggest audiences are probably employees, peers, and other reporters. Communicating our reports and encouraging members and others to read them presents a huge challenge. The reason is reports in and of themselves are just not great communication tools, although they are hugely valuable in other ways. So we need to find other ways to communicate our story using the report as a platform. This year we produced a highlights video and a short printed companion piece. These are much more accessible and are designed to get members curious about Vancity's journey towards our vision, and to encourage them to find out more by reading the annual report or 3-year plan or by browsing our website. We also developed an online build-your-own report feature that allows people to read or print only those parts of the report that they are interested in. However, we have found that our reports can be an extremely meaningful platform for ongoing engagement with members, employees, and others. For example, we've used the report as a reason to validate what community or broader sustainability issues members care about, issues that might affect their personal well-being or their communities. We've also used the report to ignite conversations about how we might play a role in addressing these issues and on some of the dilemmas Vancity faces. Of growing importance to us is the ability to demonstrate the impact our decisions, activities, and products have on members and their communities. This work will evolve, but for now we're focusing in two key areas. The first is enhanced member well-being. Our goal is to improve member well-being by offering financial products, services, and advice that meet their needs, such as financial literacy programs, accessible or green products and services. Right now, we measure well-being through a survey question, but we're working on an index comprised of specific outputs and outcomes. The second area is percentage of assets invested in impact. To date, we focused on loans to organizations. We have specific impact focus areas such as energy and environment, Aboriginal communities, affordable housing, along with detailed criteria to guide what loans we categorize as impact. However, given that the majority of our loan portfolio is residential mortgages, we're working with our colleagues at the Global Alliance to explore how we might define and track the impact that some of our conventional mortgages have. And we're also looking at expanding beyond loans to capture the buildings we own and lease, and so on. This is very much a work in progress, but on the slide I've included some examples of some of the things we currently track, and that will roll up into one of these two overarching metrics. And as well as data, we use stories a lot to show the breadth and the depth of the impact we help create. These stories are available to both employees and members through Vancity's intranet and website, and we include examples in our annual reports. This next slide illustrates some of the ways we report on our cooperative identity. There's probably nothing particularly innovative about our measures here and what we report, but the fact that we are a co-op is extremely important to us. Our co-op model allows us to think long-term and to put member and community interest before profit, believing that profits will follow by doing so. And a good example of this is our commitment to be a living wage employer. What we'd really like to be able to do is to link sustainability and financial data to prove our co-op business model works. Again, a work in progress, but we're beginning to include some examples of these in our annual reports. If I had to summarize how reporting adds value at Vancity in a nutshell, it would be reporting enables holistic, values-based decision-making consistent with stakeholder and member input in support of our business strategy. Basically, reporting is first and foremost a management tool. It also provides one reliable, complete and balanced picture of our organization, thereby increasing awareness and understanding of our business model. And because it is one integrated report, the message is consistent and reinforced. Our reports demonstrate that we walk the talk. Our reports are deemed to be very credible because they include good and bad news and because we have external assurance and so on. And so in this way, it strengthens relationships and builds trust with members and others. And it also gives us a license to innovate. It drives new business. As I mentioned, we know from focus groups that members who read our report or who understand more about us want to do more business with us and recommend us to others. And it helps differentiate us and it positions us as a leader in transparency and accountability. And we know our members care about this. The last time we surveyed members, corporate transparency and accountability was of concern to 70% of them. I'm going to conclude by attempting to answer the question, what comes first, integrated reporting or integrated thinking? Or to put it in Sonia's words, does reporting drive organizations to change, or do transformative organizations look to report what they already do? For us, I'd say it's a combination. Reporting at Vancity is viewed as an output of strategy, which indeed it should be. And over the years, we have successfully aligned the content of our reports with strategy through a combination of focusing the report on what really matters and broadening our business strategy to more deliberately incorporate sustainability factors and member input. At the same time, there's no question that reporting drives change. It brings new data and issues to the table. It facilitates discussions. It drives deeper analysis and performance improvement, and so on. In addition, insights gained from the reporting process can also be a valuable input into strategy and risk. And so on that note, I will conclude my presentation, and thanks for listening.
All right. Well, I would like to throw in a couple of things. One is the question of your data collection system. You mentioned it, but I didn't catch it. And so if you can just speak to the data collection system and how, where is the data gathered? How do you actually manage to compile this what seems to be a lot of data?
Yeah.
And is that replicable? Can other people use the systems that you're using?
Yeah, absolutely. I mean, some organizations, they build their own customized systems. We actually purchased I guess we subscribe annually to something called Credit 360. So it's an online, externally hosted database that we use. And what it does is it allowed us to really formalize our data collection process. So we went specifically to people and made them data owners, and they have accountability for entering data into this online system. So there's some work to set it up with the making sure the correct forms are in place for data entry. But once that's done, they just roll over year after year, and people get really familiar with using it. They have stricter timelines. They enter their data. There's then a data approver who is hopefully a different person who actually checks the data. The system flags if data changes more than, say, 10%, whatever you want to put in as a tolerance. So the system will flag changes over year, and it will ask the people providing the data to go in and add explanations. People can also upload the supporting documentation, and so we also give our external assurers access to that system, so they can go in and see what they need to. So it's been super helpful, and I did talk a little bit about the importance of having the people who are responsible for the data really own it and be able to explain it and be able to manage the performance. And that was a big shift in our system. It was very centralized. We used to do everything. And then over 2 or 3 years using the system, it's completely decentralized now. And it's way less work for us, and it means that the organization is also learning and using the data. So it's been a really good change, I would say. And yes, anyone can use that system. What we do pay for it is about $30,000 a year, but I'm sure that's negotiable depending on the size of the organization, the amount of metrics, and so on and so forth.
Mm-hmm. Okay, and so in terms of costs, I suspect that would be the biggest cost of your data gathering. And so, how feasible would this be for smaller organizations?
I guess the cost for us is kind of in specific chunks. So one is a data management system. The most significant costs would be around the report production. So the production of the annual report, PDF. We did a microsite this year. And then the external verification costs are quite significant for us. We do, by the way, have an integrated audit, so we have the same firm looking at our sustainability and our financial data, so that led to some reduction in costs. And then, of course, staff time. We have 2.2 people working full-time on the report, but there are so many others who actually contribute to the reporting process. But what I'd say is all those things, you need to decide what's important to you. Like as a small organization, I would say you don't want to do external verification from the get-go. You can really keep the design of the report simple to start. You can just start with the data you already collect and looking at that, and then before you begin to expand later on. So you can start off really small and just build on it as you understand the value it adds to the organization. So I think this is doable for any organization, I would say. My only, I guess my strongest opinion on this would be it does need a dedicated person. It can't be done off the side of someone's desk. And I think you do need buy-in from the top. That this is not just a communications exercise. It's going to be a tool by which you manage your business.
In terms of comparability, I don't know if Vancity does this particularly, but I know from speaking with other credit unions, they're quite interested in comparing their performance to other credit unions. And I'm just wondering, with integrated reporting, did this have any impact on your ability to compare to your peers? You're the only one doing it, so that's why I'm asking.
Yeah. In terms of the integrated reporting framework, that itself doesn't get into metrics, but it does encourage using standards that allow for comparability across industries. And actually, Yeah, we are really, it's one of the weaknesses in our reporting is that we don't have enough benchmarking data. So, when we hold our focus groups with members, they often say to us, well, this is all very good, but how do you compare to ours, particularly on the financials, for example? And so it's been a source of frustration because we really want to access more benchmark data, but we're not sure about how to go about that. And we do have some benchmarking data for other credit unions as part of a peer group network we're in, but because that's gathered for internal reporting purposes, every time I've probed, there's been little appetite to explore using it externally. So I think I want to push there a bit. So it's definitely an area for improvement. And as I mentioned in my presentation, even the GRI, which is one of the greatest benefits the GRI will say is that it allows benchmarking, but we just haven't seen that happen. There are a lot of banks who report, but still accessing comparable data is a real challenge. So I think there's a huge opportunity there for credit unions or co-ops to collaborate and identify some key metrics that they'll all share data on and that they can use for benchmarking purposes.
Okay, I just have a couple of follow-up questions. One is, do you see other credit unions becoming involved in integrated reporting?
Yeah, I haven't heard of any credit unions expressing interest, which is a shame because actually integrated reporting is such a natural fit for the credit union and co-op model. So I think the leap for co-ops to do integrated reporting is much less than traditional businesses. But also a point I wanted to make is that we're not sure if we're going to formally adopt the integrated reporting framework yet, and it's something we'll be looking at later this year. So we found being a part of the pilot super useful. And we've definitely looked to incorporate some of the key concepts and the content elements, but formal adoption is a whole other level, and then we really need to make sure we do everything that's in the framework. So we're going to do a quick gap analysis this year and really make a decision around that.
Okay, thank you. And I just have another follow-up point, and that's my last question, I promise.
Sure.
I noticed that the bulk of the participants in the pilot were, for-profit investor-owned companies. So I'm just wondering, like you did say, you thought that integrated reporting was a good fit for a cooperative. But given that the bulk of the participants were actually, investor-owned, very large commercial enterprises, I'm just wondering, as you went through the pilot project, was that an issue? Did you find that there were areas that had to be adapted in order to make the model suit the cooperative model?
Yeah, it was an issue for us, and originally the language in the framework was much stronger about the audience being investors. And there were some us, and there are some other, different types of organizations a part of the pilot who really pushed for the language to be broader there, and also to make sure that the stakeholder piece was really strong. And we feel, if we look at the framework, we feel we can adapt it for us. The language is the audience is providers of financial capital, which for us would be our members. So, and it also does speak to, being inclusive of all your stakeholders and knowing who they are and knowing what their issues are. It's just a good way of running your business. And so we do think that the integrated reporting framework is adaptable to the co-op model.
Okay, thank you.
You're welcome.
You mentioned the 6 capitals framework.
Yes.
And that sounds like the sustainable livelihoods approach the UN used for poverty reduction. They talk about assets building, and
right.
So can you expand on that a little bit? Like, what's the thinking? If you would use that sort of framework, why and how what's the combination with what you're doing now? I didn't catch that part.
Yeah, well, I think it's a really interesting way of looking at an organization, and I think it forces you to look at how you impact all of those capitals and also how you rely on all of those capitals. and to start thinking about how you can, I mean, right now you can only measure financial and manufactured in a really tangible way. The others are way harder, but it forces thinking around, well, what about human capital? And what are some proxy measures for that? So you may start to look at, rather than employees as a cost, you look at them as an asset, and start thinking about how can you increase the value of that asset through training or through the length that they've been at the organization, and start measuring some of those things too. And obviously the way the framework works is I will say, some of the capitals are much more relevant to your industry than others, so you would be clear about that up front. So for a financial institution, obviously financial and human capital would be, and probably social capital would be the most relevant for us, more so than natural capital and intellectual capital. But anyway, it's a really interesting framework for viewing your organization. And I think, as I said, our finance department is going down the road of looking at an integrated balance sheet, which I don't think any organization has done yet. There's some environmental profit and losses out there. And I think this would be a really useful framework to do that work through. But I'm not sure, as I said, we haven't adopted it yet, and we need to do probably a little more discussion and have some really interesting working groups on it internally to try and figure out where we want to go with it.
Thank you. And one last thing for me. I noticed on your indicators you had, for example, one that said a number of underserved people assisted in poverty reduction. Do you know how you capture that? Like, how do you find that figure?
Yeah, that's actually one of the ones we're still working on. So how we capture it right now is around access to financial services and credit. So we look at, we have specific products, for example, resettlement assistant accounts, low-limit Visa cards, microloans, and so on and so forth. So it's very much using products as a proxy, assuming that we are serving underserved people and presumably improving their well-being through those products. But I think, like all of our impact metrics, there's a lot of work that we need to do on them, to be honest. They tend to be more outputs rather than outcomes and impact right now. But as I'm sure you're familiar with, actually coming up with impact metrics and linking the impact to the work your organization is doing is extremely challenging. And we'll pilot the tool and see what the data shows us, and probably tweak it quite a bit this year. And
so being a cooperative, is there anything in your measurements, in your reporting, that is reflective of you being the cooperative that you would not be doing if you weren't, that you can share with us?
No, that's a tough one, because as I said, I think being a cooperative is why we can be as bold about doing what we're doing right now. Our vision to redefine wealth, and our CEO stands up there and says we are not, we really are putting members and communities first, and then profit follows, and we're trying to embed that into all the decisions we make and trying to prove that that business model works, which will be an extremely powerful thing if we actually begin to link our vision with long-term financial success and show that organizations really can be good for the community and environment and for people and make a profit at the same time.
Well, thank you very much. I really appreciate your time and the information.
Oh yeah, you're welcome. I hope it will be useful to everyone. And as I said, I'm happy to follow up afterwards if people had some burning questions which they would like to ask, or something they didn't understand in the presentation.
Great. Thank you so much. I'm sure we'll be talking to you some more.
Yeah, great. And thanks for the opportunity. I really appreciate it.